Hi, everyone. Welcome and thank you for tuning into the C2S webinar on the business of pricing carbon, how companies are preparing for risks and opportunities. I am Manjot Bhan Aluwalia, Policy and Business Fellow at the Center for Climate and Energy Solutions, and I will be leading today's discussion. Before we begin, some housekeeping items. People are placed on mute to minimize any background noise. We encourage you to ask questions by typing into the question box on your screen as you are listening to the presentations, and we will take them up during the Q&A round at the end. We are also live tweeting, so join the C2ES crew for a discussion at C2ES_org, #internal carbon pricing. Now let's begin. So for those who are not familiar, the Center for Climate and Energy Solutions is a nonpartisan, nonprofit organization that works with cities, states, businesses, and national policy makers on devising practical solutions to our climate and energy challenges. Today we have with us a great lineup of speakers across 3 global companies that are here to talk about their internal carbon pricing programs. I would like to welcome Liz Wilmot, Microsoft's Environmental Sustainability Program Manager, Anirban Ghosh, Chief Sustainability Officer at the Mahindra Group, and Bob Stout, VP and Head of Regulatory Affairs for BP America. So the plan for the webinar today is first I provide an overview of the key takeaways from our latest C2ES publication on corporate carbon pricing, which is now available for download on our website. Then we delve deeper into examples of how Microsoft, Mahindra, and BP are leading the charge on internal carbon pricing. And lastly, we would like to kickstart the discussion with some Q&A from the audience. So most of us are familiar with the concept of carbon pricing at the government or policy level, either through a carbon tax or emissions trading. According to the latest World Bank numbers, over 40 national jurisdictions globally and 20 subnationals already have a price on carbon. While we also see that carbon pricing is rising on the corporate agenda across different sectors and geographies. According to the CDP, there has been a 23% increase in the number of companies that disclosed having a carbon price in the year 2016 as compared to 2015. What's interesting is that while a majority of these companies are in North America and in Europe, but the largest increase is actually coming from emerging economies such as India, China, Mexico, Brazil, with or without an explicit government price on carbon. So that's to say that companies are voluntarily pricing their carbon emissions with or without a government mandate. What carbon pricing essentially does is that it puts a dollar value on the greenhouse gas emissions associated with a business activity in this case. It is a financial metric that is easily understood across all business units, right from your financial manager to your shop floor engineer to the chief executives of your company. Now, without going into details about everything on this slide, I would like to describe what are the different types of carbon pricing approaches that companies are using. So companies use different types of approaches, such as a carbon fee, a shadow price, and some have known to use an implicit carbon price. We must note that each approach has its benefits as well as challenges, and companies must evaluate trade-offs based on their objectives, their business strategy, the sector they belong to, and the geography they are located in. So a carbon fee is an actual monetary value on each metric ton of emissions charged to business units in proportion to their emissions, with the key objective to create a revenue or investment stream that can pay for projects and guide investments that reduce a company's greenhouse gas emissions. Because it is an actual fee, it incentivizes behavioral change among employees and helps drive accountability among different business units. A shadow price, on the other hand, is a theoretical value that is used by companies in their project planning processes to make large capital expenditure and R&D decisions. It can help companies shift investments to low carbon options or screen for investments that would yield a higher rate of return in a carbon-constrained future. In that sense, it helps companies future-proof against any carbon pricing regulations. Implicit carbon pricing is a little different from the two approaches. It retroactively is calculated as the amount a company spent on reducing emissions and or complying with regulations, essentially the marginal abatement cost. And often companies use this as a benchmark before they formally launch a carbon fee or a shadow price. We must remember that not every approach that we've talked about is mutually exclusive. What we did hear from companies that we interviewed and analyzed for our report, that some companies actually use a hybrid of these approaches. For example, a company may use a carbon fee to meet its greenhouse gas reduction targets and a shadow price to make long-term investment decisions. We found that companies are adopting an internal carbon price for several reasons: to advance their ambitious greenhouse gas reduction goals, be it the RE100 goals, the science-based targets, the EP100s, or other GHG reduction efforts in operations and across their value chains. What we found is that over half of the companies that have signed on to initiatives such as the RE100 and half of the companies that signed on to science-based targets at least have an internal carbon price or plan to have one by 2018. Carbon pricing helps companies prepare for better and anticipate future carbon regulations by shifting their investments to low carbon options. We see that companies are also responding to the signals of the Paris Agreement, where over 90 of the 180 countries that signed on to the Paris Agreement committed to using market-based approaches, either a cap and trade or a carbon tax, to meet their national commitments or their NDCs. Another point we noted that companies are using an internal carbon price to respond to the call for greater disclosure from investors and shareholders. For example, people are familiar with the Task Force on Climate-Related Risk Disclosure, which is an industry-led group chaired by Michael Bloomberg that recommends that companies quantify the financial implications of climate-related risks. We found that internal carbon price is one way to show to investors that companies are serious about managing those risks. Some of the other benefits that companies described were gaining a competitive advantage, building resilient supply chains, and showcasing corporate sustainability by engaging with their suppliers, customers, and communities. I would also like to describe the different lessons learned from company experiences. The first being that corporate carbon pricing is an important risk mitigation tool to manage climate-related risks and explore opportunities of a low-carbon future. An internal carbon price is most meaningful if it is integrated in a company's larger sustainability or business strategy. What we also saw that for a carbon fee, the price may be secondary to the actual signal it sends internally. For example, even a relatively low carbon price can in fact lead to change in behavior and make employees seek innovative ways to reduce emissions. Now for a shadow price, because it is a theoretical value, it needs to reflect that the cost of climate change will increase over time. To meaningfully have an impact on investment decisions and prepare for risks, companies could consider setting a price higher than the current government carbon pricing levels, which are $10 per metric ton on an average, and have it on the lines with the high-level Commission on Carbon Prices, which is $40 to $80 by 2020 and $50 to $100 by 2030. And lastly, carbon pricing is one of the many tools companies can use to help manage risks. And companies should use this in complement with other corporate greenhouse gas reduction approaches. Well, that's all from me. Now we move on to learning about different companies and examples as to how they're implementing a carbon price by starting with Microsoft's carbon fee. Over to you, Liz.
Thank you, Manjo. This is Liz Wilmot, and I lead Microsoft's carbon program, and I will talk with you today about how we're using carbon pricing to meet our operational commitments and to drive digital transformation. Next. Next slide, please. Great, thank you. Our sustainability mission is to empower every person and every organization on the planet to thrive in a resource-constrained world. As you're all aware, there are serious and growing environmental resource constraints that impact us, communities worldwide, and all of our customers, and we've set a mission to do our part to address those. Next slide, please. Back to our focus area slide, please. Thanks. We're focusing on 5 areas in which we've made both operational and societal commitments: energy, carbon, water, ecosystems, and circular economy. And we're using our carbon pricing model and leveraging technologies to accelerate resource efficiency on a global scale. Next slide, please. In 2012, we committed to be carbon neutral by the end of the year. We met that goal then, and we've met it every year since. And during that time, we were expanding our cloud business substantially and building facilities and networks globally to keep pace with our business. In parallel, our carbon neutral commitment changed the way we operate around the globe and has become the cornerstone of our sustainability efforts company-wide. More recently, we have focused on how we can use technology to drive carbon reduction with our customers and in society as a whole. Next slide, please. So I'll tell you about the mechanics of how we do it. We assess emissions for a given year, a forward projection of future year electricity consumption, direct emissions, and business air travel. We develop a budget for our investments based on those emissions, how much we need to pay to meet and report on our commitments, and a fund for technology innovation in the area of our 5 sustainability goals. We then set the price level based on calculating our investment need and dividing that by the business group emissions derived from electricity, direct emissions, and business air travel. And the price can change year over year based on our budget. However, the Microsoft fee has ranged from $5 to $10 a metric ton in recent years. Next slide, please. The operational results have been clear. We've met our carbon neutrality commitment, our 100% renewable energy commitment, and we've achieved significant cost savings. Since 2012, we've purchased 14 billion kilowatt hours of green power and reduced over 9 million tons of carbon equivalent, including offsets. Now we're using it to drive digital transformation across our sustainability focus areas. 2 real-life examples of how these commitments help communities around the world, which particularly excite me and have occurred in the past year. First, carbon credits from rice farming practices that reduce methane emissions and water consumption. In FY17, we purchased carbon credits from rice farmers in the US Southeast who banded together to adopt an alternative practice of watering and drying that can reduce methane production by 60% to 90% and reduce water use by 30%. Needless to say, rice farming margins are low, and with farmers seeing drops in profits, resource efficiency is increasingly critical for this sector. The second example is farther afield across the globe. We've invested in renewable energy procurement that has supported small and large countries' achievement of their Paris climate commitments and clean energy agendas. And in the case of this example in Taiwan, we purchased 3,000 megawatt hours of small-scale hydro RECs, representing 100% of our annual energy consumption, electricity consumption in Taiwan, and avoiding 2,000 tons of greenhouse gas emissions there. Though small, our purchase has signaled support for the Taiwanese government's renewable energy agenda, including 20% renewables by 2025 and a phase-out of nuclear energy. This signal from Microsoft in investing in the small-scale hydro RECs was enough so that Microsoft was invited as now participating in a renewable energy advisory board for the Taiwanese president. In addition to these examples, small though they may be, we've also conducted a climate vulnerability assessment of our facilities, and looking ahead, we are excited to expand this work to help our supply chain and to set and meet robust climate goals. Next slide, please. We have also focused on using the carbon price to fund digital transformation for sustainability, and this is an evolution of the program. In addition to driving behavior change, we have also directed the revenue toward catalytic investments in energy, including off-grid clean energy access, a partnership with the Norwegian utility Agder Energy on distributed energy resource optimization. In terms of carbon, we've partnered with a nonprofit called Watt Time, which is now part of Rocky Mountain Institute, on a real-time carbon emissions platform. In terms of water, we've partnered with Ecolab on a tool called the Water Risk Monetizer that helps companies and institutions understand their risks to water shortage. And last but not least, we've launched a program called AI for Earth, which is aimed at empowering people and organizations to solve global environmental challenges by increasing access to artificial intelligence tools and educational opportunities. And those projects include land cover mapping, Project Premonition, which is a really interesting project that uses mosquitoes, the DNA of mosquitoes, to track biodiversity health in areas around the world. And finally, Farm Beats, a program using IoT for smart agriculture. So in sum, the program has more than met our operational commitments, and we're now looking to the next stage to use it as an engine to drive our digital transformation agenda. That's it. Thank you.
Great. Thanks, Liz. It's nice to hear how Microsoft is actually using an internal carbon fee and leveraging technology to not only meet its carbon neutrality goals, but also engage through its value chain and promote sustainable development across the communities and serving its customers where it operates. Next, we will hear from Anirban as to how and why Mahindra, the world's largest tractor manufacturing company, became India's first company to launch an internal carbon fee. Over to you, Anirban.
Thank you, Manjot. The story of carbon pricing in our company started with an understanding of what we wanted to do in sustainability. Manjot, if you could change the slide, please. Over time, a framework emerged around which our work in sustainability is grounded. You will notice in the center pillar a point mentioning achieve carbon neutrality, and carbon price was one of the tools that we are using to move in that direction. We're very far away from carbon neutrality now, but that's the direction we are moving. Could we change the slide, please? Manjot has made my work easier on this slide by explaining various forms of carbon pricing that can exist. And the only thing that I want to mention on this slide is that the carbon fee, which is part of the real carbon price, there is an actual cash flow in terms of an investment, whereas in a shadow carbon price, there isn't an actual cash flow. Though it can be argued that a shadow price leads to the purchase of equipment whose nominal price may be higher, but whose carbon footprint is lower. Fortunately, because this webinar is structured so well, you will get a chance. We will hear about a shadow price from the BP presentation. So the price that we have in our business in Mahindra can be classified as a real, internal, explicit price. And you can see why I say so. Could we change the slide, please? Looking at this way, the definition of carbon price that we've adopted is the value of all investments made and initiatives taken to reduce the carbon footprint of our corporation. We change the slide, please. Broadly, the investments go into the areas of energy efficiency, renewable energy, biofuels, afforestation, everything that helps to reduce the carbon footprint of the company. Could we change the slide, please? And to do this, we participate in the EP100, RE100 programs, and our afforestation program is called Mahindra Haryali. Change the slide, please. Now, the areas in which one invests in offices and buildings are listed here on this slide. This is where the money that is raised from the carbon price goes in, and that entire box which comes under carbon are areas for action in offices and buildings. Next slide, please. In factories and construction sites, the areas in which the investments go in are listed here. One of the important ways in which we look at carbon pricing is to enable the use and construction of green buildings, which have a much lower carbon footprint than regular buildings. We've also found that investments in these areas more than pay back for themselves, and on many projects, our returns are in excess of 24%, which by all standards are very handsome returns indeed, and sometimes even higher than what the core business returns on a year-on-year basis. Therefore, it makes sense to use a carbon price and make investments in projects that help to reduce the carbon footprint of the company. Next slide, please. Our commitment, therefore, is to spend $10 per ton of carbon emitted on technologies and processes and methods that help reduce the carbon footprint. Just want to mention here that whenever we are talking of a real carbon price, that's a carbon fee kind of a carbon price, the nominal value of the carbon price is lower than when one looks at it from a shadow price perspective. And Manjot explained it in her presentation in terms of the ranges of prices which you could see. Next slide, please. Using this investment, we expect to reduce our carbon footprint by 25% by 2019. Next slide, please. Now, even as we talk about the carbon free and the shadow carbon price, it is entirely possible to use both of them in a manner in which they complement each other. And we are in the process of looking at what our shadow carbon price could be, which we would use in a manner which would help us in procurement of equipment and choice of projects. It is likely that the shadow carbon price will be in the range of $50, but we haven't yet decided on that. Next slide, please. Just to give you a brief summary of where the real price and the shadow price goes, the real price typically one uses to make investments, actual investments in reducing carbon emissions, and one uses the shadow price to choose equipment options and to revisit returns from a project by pricing environmental impact. Next slide, please. Since we know that climate change is a reality, we believe that a price on carbon could provide an economic spur for nations and businesses to follow a low carbon path, a path that we must inevitably follow if we are to meet the 2-degree goal. And we believe that, next slide please, doing this will help us all rise for good. Thank you very much.
Great. Thanks, Anirban. Thank you for that presentation. It's great to learn how your carbon fee is actually well integrated into the larger Mahindra Group sustainability framework. And I'm also excited to hear about your shadow pricing program and this very much be, the hybrid carbon pricing approach that we talked about, where companies can use a combination of a carbon fee and a shadow price to help meet multiple objectives. Well, next we have Bob Stout from BP, who will tell us more about the shadow price at BP and how the company is preparing for a low carbon future. Over to you, Bob.
Thank you very much, Manjot. Yes, this is Bob Stout. I'm the Vice President of Regulatory Affairs for BP America here in Washington. And let me just start by thanking Manjot and C2ES for this opportunity, and also for the excellent report, which really provides, I think, a lot of good context and information on various forms of carbon pricing that are used in industry. So, as in many areas, an excellent analytical approach that reflected there. So what I'd like to talk about today is just what BP's shadow carbon price is, why we've adopted it, and then finally how it fits into our broader approach and strategy to dealing with advancing low carbon. Next slide. So what is the carbon price? And here are the details of it. So we use a shadow carbon price of $40 a ton CO2 equivalent, and we adopted that in 2009, so we've been doing it for quite a few years. As reflective of one of the points in the report about the importance of continuing to review and modify, we did adjust it in 2015 so that it now actually reflects a real versus a nominal price, which means we inflation adjust it using 2014 dollars. We also do perform a stress test, meaning an upper bound, $40 being the base case, and we currently use an $80 stress test as well. And in those jurisdictions where there might be a lower price, we might also use a lower price sensitivity, but $40 is our base case in real dollars, inflation adjusted to 2014. We apply this to large new projects, and we have a materiality threshold of 100,000 tons CO2 equivalent per year, and we apply it in the developed countries where we operate, whether or not climate legislation has been introduced or is in place, and also anywhere we apply it when we bear 100% risk for the project, meaning we have 100% equity interest or 100% control of the project. In addition to looking at large new projects, it also can be applied to incentivize efficiency or reduction of GHG emissions in existing operations, even at a smaller level. And this is an important point, that when somebody is looking at design of a project, even within a broader one, this can be used, of course, to quantify the emissions reduction benefits in the financial review process. And finally, it includes methane as well as CO2 emissions, both directly from our operations, indirect from energy imports, i.e. electricity, and then also indirect emissions from hydrogen production. So that's essentially what it is in a nutshell. So why has BP adopted a shadow carbon price? Next slide. First of all, climate policies are, of course, in force or in development in many countries. That was referenced earlier by Manjot, and we're very acutely aware of it. And by 2020, we think maybe 2/3 or more of our emissions will be in countries that actually have carbon policies. So a key reason to do this is the policies are coming into place, and obviously as good business you want to be sure you understand them, and in particular portfolio resiliency, the resiliency of the portfolio that we have and are developing is a very important consideration for any long-term global sustainable energy business. It really just is good business, and it's also, of course, a one tool to help promote consideration of actual or potential future carbon pricing, both in large new projects and design of projects, as I mentioned before, as they affect GHG emissions. But the overall headline here is it's an important tool. The carbon price itself is an important internal tool for us in evaluating portfolio resilience to future or current carbon policies. Next. And this is really an important point. So I've quoted here directly from the report. Many pieces of it resonated well with me, but particularly this one. In the carbon pricing is one of many tools and it's not sufficient in itself to do what we want to do in terms of the transition to a global low carbon economy, and it needs to be complemented with other strategies. So for us in particular, it's only one tool in a large and growing toolbox that we use to advance low carbon, and we pursue this both as an individual company, but also very importantly collectively with others, business, government, and NGOs, and of course we are members of the Business Leadership Council for C2ES, and that's one of the important NGOs we work with in this regard. And so I thought I would just spend a few minutes on the following slide summarizing some of the other things we're doing, tools in our toolbox that work synergistically with the carbon price. And for more detail here, I just have a site to our sustainability report. But let me just cover a few of the larger ones. Next slide. So another thing we do is we publish an annual energy outlook, which began as sort of an economic analysis that we did for ourselves, and it still is very important to inform our own decisions, but we publish it and we roll it out quite widely. And one of the things we do, and this is one slide from that, is we look at a base case of what we expect out to 2035. So the outlook is for 2035, and what you see here is the current energy mix, what we would project in a base case, which is sort of a middle case considering some policy, but then we also do now a faster transition, an even faster transition case that looks at the impact that we would expect to have in the faster transition case of a $100 ton carbon price, and in the even faster transition case, something that might resemble the IEA's 450 scenario. And as you can see here, it makes an impact in terms of both greenhouse gas emissions and the different portfolios of energy. In all of these cases, out to 2035, it shows, as so many other analyses do, that oil and gas will continue to be a larger portion. But the benefit of this, of course, is for us and for others that we publish this to, looking at how policy can actually impact different portfolios. And again, from a business standpoint, that helps in terms of looking at portfolio resilience. Next slide. And these are some of the things that we're doing in advancing low carbon, and it was very helpful to hear also examples from my colleagues at Microsoft and Mahindra. But one, we advocate for a price on carbon. So in addition to advocating for US involvement in Paris, we and other companies have advocated for a price on carbon, including broadly and then with specific groups I'll talk about in a minute. We're also growing natural gas within our portfolio, which plays an important role on its own, but also in terms of enabling development of renewables. About half of our portfolio today is gas, and we expect that to be growing significantly over the coming years. Delivering energy efficient operations in our energy efficiency in our operations is important, and the carbon price, of course, helps with that. But we also work on initiatives to address our customers' emissions and through products. And just a couple examples there that are sort of interesting and maybe off the beaten track in terms of what people might generally be familiar with. So BP has the Castrol lubricants business, and one of the things that we found we've been able to do through improving our lubricants is decreasing the viscosity and thereby improving vehicle efficiency, and have seen some substantial benefits there from an emissions standpoint in the transport sector. We also have a target neutral program which we offer to our customers, which is a program to offset carbon emissions, and I was very interested to hear what Microsoft is doing, by the way, with rice and methane as well. But that is a program, like over the last 10 years, we've been able to reduce about 2.5 million tons of CO2 equivalent through programs that we offer to our customers, and so that's another way. And then obviously investing in and collaborating on lower emissions technology. So we have the largest operated renewables business in the energy industry, which is in particular wind and biofuels. We have a very large wind industry, and we continue through our venturing arm to grow other businesses such as biofuels, and I suspect you'll see much more to come over the coming months and years. So those are some of the things we do individually as a company. Next slide. But I also wanted to highlight, and this is extremely important in my view, and highlights the importance of groups like C2ES. So these are some of the external initiatives that we participate in. The CCAC, Climate and Clean Air Act Coalition addressing oil and gas methane reduction, the World Bank Group's Elimination of Routine Flaring Initiative, which we have endorsed as well. The Climate Leadership Council, which is a new group with which some of you may be familiar. This is a group that was formed by folks like James Baker, George Schultz, Hank Paulson, and others, and BP and the other companies listed here were founding members of that, and that is to advocate for carbon pricing, and they have a program that they are proposing with specific pieces with respect to carbon dividends. And then finally, the Oil and Gas Climate Initiative, which is a major initiative for us and these other companies that are listed, and I'll cover that briefly on the next slide. So this is a CEO-led initiative, and our CEO, Bob Dudley, is the chair of the Oil and Gas Climate Initiative. Started in 2014, and the companies participating represent 20% of global oil and gas production. In addition to working together on policy matters, the group really is focused on investment and selection of technological improvements that can be made to reduce emissions. And so this group has made a $1 billion investment commitment over 10 years, and focusing on investment in things like carbon capture and use, and also methane reduction. And there are other topics that they're looking at, such as energy efficiency and sustainable mobility. So I think that is a very important group for us and others who are in the energy industry, and one of the ways that we are really participating in the process. So I'll stop there and pass it back to you, Manjio.
Wonderful. Thanks, Bob. This was a great perspective on carbon pricing and how actually a company in the oil and gas sector is looking at managing its future climate-related risks. So we have all these great questions pouring in, but I thought we should get kick-started with some overarching high-level discussion questions for the speakers before we take up the Q&A from the audience. So something to get kick-started on is, do you think the corporate use of internal carbon pricing will increase in the coming years? And this is to all the three guest speakers, so please feel free to chime in.
I'm happy to jump on this one. This is Liz. I definitely think this is true. We're seeing an increase in the requests for information about Microsoft's carbon fee. We have a robust schedule of speaking engagements like this, not only with corporates, but also with universities and cities as well. For example, next week we'll be speaking at Boston University for their local university initiative, as well as the Boston Green Ribbon Commission, and the list goes on. And we see the same actually with a demand for the real-time carbon emissions platform that we offer, which is based on measuring carbon emissions based on marginal rates versus annual average grid factors, and is more like getting being able to access your bank information on a real-time basis versus getting an annual statement which on your bank, which is not particularly useful. So we really see a demand for all of these things, and just a real strong interest from not only corporates but other institutions.
And this is Bob. I would just add, yes, I think Liz has it exactly right, and I would say we're seeing exactly the same thing. I would say increasing interest, so I would expect to see more usage, and also I think probably increasing sophistication and refinement And this is where, again, it's good to have a report like this coming out to make this more known more broadly. But I think that we and many other companies will be continuing to look at, how do we make it effective, continuing to look at what the right price is over time and so on. So I think this will continue to be important over the coming years.
This is Anirban. Given that carbon pricing is logical, rational, and effective, and when used well, enhances competitiveness of a business, I think it would be folly not for carbon pricing not to expand in use in the coming years.
That's great. And it's also very interesting to see that not just corporations, but as Liz mentioned, universities are looking at carbon pricing internally to help meet their ambitious sustainability goals and reduce their carbon footprint. So that's great to hear that there's momentum and it's going to increase over time. So to what extent do you think internal carbon pricing is a helpful tool for your particular sectors, given ITC, manufacturing, oil and gas? If you could just talk a little bit about your sector-specific nuances and how the learnings have been for your particular sector and the usefulness of this tool.
I'm happy to jump in again. As folks know, as we move more and more of our business societally toward the cloud, and as individuals we live in a more device-connected world, our data center energy consumption is growing, and so from the perspective of being responsible environmental stewards and also driving toward a more efficient, resource-efficient cloud, we see our carbon prices being the key touchstone for that, the key engine for that, that digital, not only digital transformation for sustainability, but also doing so in a way that is equally sustainable.
This is Anirban. The most interesting thing that has happened after we've adopted carbon pricing is that the investments cleared in technologies to reduce carbon footprint have gone up by a factor of 10, because it's easy for us to see that the returns on these investments are good. So even as we reduce carbon footprint and make the business more resilient, we are able to take system cost out of the P&L, and it's a win-win all over. So therefore, it's an extremely helpful tool for the manufacturing sector.
So this is Bob. Yes, I would agree with all of that. And while not speaking for obviously every single company in the oil and gas industry, I think it is a tool that is used quite widely. And the benefit of, one of the benefits of a shadow carbon price, I think, is, when you have a very large sector like we do with, very large scale business, multiple actors involved, very complex in terms of commissioning and doing capital investment analyses for projects, it is a helpful way to sort of systematize the consideration of carbon pricing as a policy. And as that grows, as carbon pricing grows, as we hope it will over time, I think it will become increasingly important. So it's just a systematic way to do this that I think works well overall, again, with the caveat that it's only one tool. It is a helpful tool in terms of analyzing projects for emission reduction opportunities, but it needs to be mated with a broader strategy as well.
That's great. Thanks for those responses. And I guess I would just add that we are seeing a rise in internal carbon pricing, not just in the ITC, manufacturing, and oil and gas sectors that these companies represent, but we're also actually seeing that companies across the board in the telecom services, in the banking sector, in consumer staples, consumer goods, and healthcare, we have been seeing an increase of late in internal carbon pricing. And of course, to the point that companies are using this by combining with other carbon pricing approaches. Well, I guess the third question is, how can corporate carbon pricing help us achieve the goals of the Paris Agreement? And I would like to club this question along with a question from the audience, which is, on everyone's mind of late. Do you think the exit of the US from the Paris Agreement could have a negative effect on corporate carbon pricing practices?
This is Liz, and I'll jump in to say, first and foremost, carbon pricing for us is a key piece of meeting our goals relative to climate change. And so I see it as being crucial to meeting the Paris Agreement, not only for the operational commitments of subnationals such as ourselves, as I mentioned, corporates, universities, and cities and states, but also in terms of how we can, as companies, can enable partnership and collaboration with countries to help them meet their Paris targets. And so, in that sense, I think we have a wake-up call in terms of being able to, not only with what's going on in the world on a climate impacts basis, to really step forward and offer solutions, regardless of national policies. We have an opportunity to offer direct climate solutions.
So this is Bob, and I'll just add to that, and it's always great to follow my colleagues because I agree with everything that's just been said. And I would just say that as a global company, we have to be attentive, and I think other global companies have to be attentive to advancing low carbon, to dealing with climate change in all of its aspects, as well as policy as it's developing. And I don't think the U.S. withdrawal from the Paris Agreement, as announced, will change that significantly, certainly not for global companies like ours. Again, I think carbon pricing can help. I also think, and among the various things that I was talking about here, I think the role of technology is really important, both in terms of reducing operational emissions, but also for us in helping those who consume our products do so in a way that's more efficient and with a lower carbon footprint. So I think all of those things need to be catalyzed, and the carbon price can help, particularly with portfolio resilience and as one looks at one's operational emissions. But I think the broader piece is important, and there again, I think technology is growing. Companies are investing more and more within their sectors in the technologies that will actually make a difference.
Carbon price can get really interesting. It's kind of got started with internal carbon pricing, a little bit of carbon pricing by some of the governments, but one can get innovative with the use of this tool to get more and more people to work towards a low carbon future. And that would help in achieving the goals of the Paris Agreement. I think in future, we will see newer, more interesting ways of using carbon pricing. So far, it's mostly internal, that is within an organization. I'm looking forward to see how governments use carbon pricing to drive organizations and society towards a low carbon future. I think there are interesting times ahead.
Interesting times ahead indeed, and it's great to see the climate leadership that companies are showing, and carbon pricing is definitely one good example of that, especially in the last few months. So I guess now we'll get to the audience questions that have specific questions about the implementation and effectiveness of the carbon fee and the shadow price. So the first question I have from the audience that probably is more relevant for Microsoft and Mahindra or companies that have a carbon fee, that to what extent can a carbon fee be used to fund a complete reduction in a company's carbon footprint?
Could you repeat the question, please? I had a little bit of feedback.
Sure.
Yes, please.
So the question is, can a carbon fee be used to fund a complete reduction in a company's carbon footprint?
Sure. So we set a carbon neutral commitment in 2012 to reduce our emissions to the point we could and then offset the rest. And so from that perspective, yes, we have used our carbon fee. In terms of other companies, I think it really depends on the nature of the business. For us, we still have a significant amount of business air travel, which is the part that we need to offset. And so that, due to the nature of our business, is not going to be completely reduced to zero until our dependency on the airline industry and the airlines have gone low carbon or zero carbon. But in terms of meeting our carbon neutral commitment, it has been integral.
Yeah, I agree with that. Will a carbon fee lead to any business becoming zero carbon? Probably not. And that's because I don't think we know how to live life using technologies that have no carbon footprint. A case in point is travel. However, carbon fees will help in adopting the lowest possible carbon path, and I think that is a big step ahead. I don't think we even want to become a zero carbon society, probably because we can't envisage the possibility yet. But therefore, it's a useful tool and it can take us quite far. For an automotive manufacturer, there is an interesting possibility that you stop manufacturing fossil fuel based vehicles and start making only electric vehicles at some point in time. It leads to a massive reduction in carbon footprint, both in manufacturing as well as in the scope 3 emissions from vehicles. Probably the government will use a carbon pricing tool of some kind to make that change happen at some point in time.
Thank you for those responses. And Anirban, there's a question specifically on the $10 per metric ton carbon fee that is used by Mahindra. And you mentioned in your presentation that the carbon fee is used to support the 25% reduction in greenhouse gas emissions by 2019, which is your carbon commitment. Could you give a sense of the relative impacts of this price increase on business units because of the carbon fee to reduce their consumption versus the impact of using the carbon fee funds to invest in efficiency? So have there been any gains when you compare the trade-offs of actually putting a carbon fee and getting that consumption and funding to invest in efficiency?
Manjot, the answer I'm thinking of is rather simple. May I ask you to repeat that question again, just to see that I haven't heard it wrong?
Sure. So I guess the question is, what have been the relative impacts of the price increase on business units reducing consumption versus the impact of using the carbon fee funds to invest in efficiency?
We've actually followed the latter path by choosing to earmark funds to invest in efficiency. And that has given us great results. There is a built-in incentive for business units to reduce their carbon footprint, because then, since the carbon price is tagged to the tons of carbon emitted, if their emissions reduce, then they need to make lesser investments, both of which tend to lead to a virtuous cycle, and the end gain is positive either way. So just the best way I could think of summarizing the answer is that we followed the second path. It sort of builds in the first path in some way, and together they lead us towards a lower carbon footprint. I hope it helps.
That sounds good to me. And I guess the question for all three companies is that how are your companies arriving at your assumptions for a carbon fee versus a shadow price? How do you decide what is the best model to choose? And another question tied to that is, what are the main sources of inputs that you're relying on for your financial models?
Right. All three of us, I think, find the question a little difficult to deal with. So let me try. I think it's really not a choice between a carbon fee and a shadow price. We think it is complementary. We found it easier to make the commitment on a carbon fee, but it's a matter of time before we also start using a shadow carbon price. Using a carbon fee, we are saying that we will invest in equipment and technologies which will take us on a low carbon path. But at the time of purchase, the use of a shadow carbon price helps in choosing the more environment friendly option. Therefore, it is complementary, and I think over time, more and more organizations will choose to use both as they go forward. I hope that helps answer that question.
So this is Bob. Thank you very much, Mahindra. It's a difficult question. I mean, we decided to implement a shadow carbon price, as I indicated some time ago in 2009. I will say that we, are regularly, actively reviewing the price, the program, and that will continue. But as to the inputs, I'm not going to try to list them, but I think the one thing I will say on that is, and this is the advantage of a shadow carbon price or even a fee, but I mean, the inputs are from the business, part of the capital appraisal and investment process, and it is, it is just woven into how we look at projects. And so I think what's most important is that the inputs be the kinds of inputs that are understood and applied in the normal course of business, because one of the benefits of this then is that those involved see that in a concrete business way, as opposed to thinking about this as something that's being done for, outside of the normal business process.
And this is Liz. I would just say we've had our direct carbon fee since 2012. As I mentioned, we base it on a projection of the investments we need to make to meet our public commitments and to invest in technology projects. And so it's driven by that, as well as our greenhouse gas emissions inventory.
Great. And I know we are almost coming to a close, but I'm tempted to ask this another question, which actually speaks to why are companies pricing their carbon emissions, and one motivation or one reason for doing it is making sure that you showcase to your investors and shareholders that you're adequately managing climate risks. So there's one question tied to that, that have you seen any meaningful examples of equity or debt investors using your price on carbon in the way they evaluate you as an investment or a lending risk?
This is Anirban. Carbon price is an important part of our conversation with investors on our ESG calls. And over the last year, there have been a number of occasions when we've heard that investments were made into our stock by investors because of the impact of the ESG calls. In a recent meeting in London, where we had investors, stock exchanges, as well as corporations around the table, it was very clear that the assessment of the ESG actions by corporations was moving from the periphery of analysis towards the center. And at least one investor organization mentioned that they use ESG information actively to sift which corporation to invest in and which ones to not invest in. So clearly it's a train that's gathering steam, and in future one can expect that it'll just go faster.
This is Liz. We haven't seen a specific example, but I would not be surprised if that trend increases over time, especially as we've seen Bloomberg and Carney and their efforts rise in focus. And so definitely we're looking out for that.
Yeah, and this is Bob. I agree. I can't cite a specific example, but it just stands to reason that investors, in looking at enterprises, of course, are looking at, are they resilient to all kinds of changes in the future? Is their portfolio built in such a way, and are their business processes designed to take that into account? And climate change and carbon pricing as a policy obviously are key factors that businesses need to look at, and so while they may not understand how every individual decision is made, knowing that the business processes take account of it in one way through a carbon price, I think helps them understand how the resilience of that portfolio.
Fantastic. Thank you for all those great questions and responses. Unfortunately, it looks like we're out of time to answer all the questions pouring in. If you would like to continue the discussion offline, please email me your questions at bhanm@c2es.org. And you could also download our C2Es brief on corporate carbon pricing on our website. And I would like to thank our speakers dialing in from India and the US for shedding light on the internal carbon pricing programs and for being such great climate leaders. And thank you to the audience for tuning in, and I hope you enjoyed the discussion. Have a great week ahead. Bye.